Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kiczula. Today, I've got Ashley Tison on the podcast, and we're going to be talking about opportunity zones. Let's jump right into the episode.
Brian, thanks for having me on today. It's an honor and a privilege to be here. I love opportunity zones. I think that they are the most powerful legislatively created tax incentive ever. And the really cool thing about them is that even though they are so powerful, the legislator made it easy to do for ordinary investors like you and me. So the great thing is it's as of right. You don't have to ask for permission from anyone. You can go and do these deals as long as you have a capital gain. You take that capital gain and you get it into a qualified opportunity fund within 180 days. And a qualified opportunity fund can be something as simple as an LLC taxed as a partnership. So it could be your own qualified opportunity fund. We call them captive funds. I think we've set up more than anybody in the country at this point in time. And you take that money, you put it into a qualified opportunity fund, you get to defer the taxes on that original capital gain. And that capital gain could come from anything. It could come from real estate. It could come from the sale of a business, appreciated baseball cards, stock, whatever. It doesn't matter, as long as it's a capital gain. And then you invest that money from the fund into qualified opportunity zone property, which can either be an operating business or it could be real estate type transactions. And then you got to defer the taxes, you hold for 5 years, you get a reduction in the taxes. It's 10% if it's in a regular fund. It's 30% if it's in a rural qualified opportunity fund. And then on the back end, after a 10-year hold of your investment in the fund, you get a step up in basis to fair market value anytime you transact on any asset that's owned downstream from the fund. And so that's really significant because it not only eliminates capital gains, but it also eliminates depreciation recapture, which for your folks that have done cost segregation studies and have sold before the makers has caught up for them, so they've sold inside of 5 years or 7 years or 10 years or 15, they have a certain amount of depreciation recapture that they get hit with. And opportunity zones eliminate that.
So the cool thing is it doesn't have to be real estate to real estate. And I think a lot of people might miss that.
That's right. I neglected to mention that you do have to have the business or the real estate's got to be located in a qualified opportunity zone, which were designated by the governors after 2017. And it's basically 25% of their low income census tracts that they got to designate.
Okay. And then so what you're doing is you're moving the money from whatever you sold, and you're putting it into an opportunity fund. So you're establishing an opportunity fund that's then going to buy the individual assets. Is that the correct flow?
That's exactly right. You don't have to use a qualified intermediary like you do in 1031. You don't have to have any special kind of tracing. It could be money from anywhere. You just have to have a gain that you report on your taxes. And then you put the equivalent amount of gain into a bank account that's owned by your qualified opportunity fund.
Okay. And you're helping establish those qualified. Are you establishing opportunity funds for individuals? Or are you going in and setting up one opportunity zone fund and then using that as the, let's call it the bank, to then go purchase the property?
Yeah, it's typically the way that they do it. So you've got two kind of just general concepts. You've got somebody that has their own capital gains and they want to do a captive fund. They want to do their own deal. Or you've got somebody that may have their own capital gains and they want to bring in investors. And so they'll actually do a securities offering and syndicate the cash coming into their fund. So that way they can go do more deals. Your qualified opportunity fund is going to be kind of like a holding company. And then you set up a qualified opportunity zone business, which once again is just a partnership. Your qualified opportunity fund owns typically 99% of that qualified opportunity zone business. And then that's where you buy the property, you operate the business, that kind of thing. Your fund kind of functions almost like a holding company.
Okay. And then are you tied up as far as timeframes go? Do I have to identify a property within a certain period, like a 1031 exchange?
So you've got between 6 months and a year before you have to deploy the capital out of the fund. But the easiest thing to do is just put it into a qualified opportunity zone business, which once again is your owned LLC. And then you hit that time frame on that. And now you've got 31 months to spend the money. So worst case scenario, you have 37 months. Max case scenario, you have 43 months from the time you put your money into a fund. So 43 months is a really long time.
You're right. what if you're in a scenario, and this is like one of those curveball questions, because I did have a client that we were looking at doing a cost segregation study on some of the properties that he had built. And the challenge that he had is the construction of the properties took years instead of months. And he had financing on the properties that he was building. Is there any problems with that? Does he run the risk of losing the tax benefits from the opportunity fund because the project wasn't completed on time? So that's the first question. And the second one is, can you put funding on it? So you want to put debt on a business or property that you're acquiring.
So I'm going to answer the second one first. You can absolutely use debt, and you can use it at the outset for construction, or you can actually refinance. And as long as you put the money from the refinance into another deal in an opportunity zone, you don't have any lockout period. On a cash out refinance, there's a 2-year lockout. But after you've held your investment for 2 years, you could do a cash out refinance and pull all the cash right back out of it. On the first one, if you miss, basically have 43 months, right? So if there's delay that's outside of your control because of governmental action or whatever, you've got up to an additional 24 months for that. So like when COVID happened, you got an additional 24 months. If it's just because you got shady contractors, then unfortunately you would bust out at the qualified opportunity zone business level. But if you return the capital up to the fund, would then have 12 months to reinvest it into another qualified opportunity zone business. So there are some ways that we can fix it. If you hit roadblocks or there's something that happens, it's a conundrum. We got a lot of flexibility inside of the program. So we can typically fix things. And you do have a 6-month grace period if for whatever reason you miss a test at the QSEB level.
Yeah. And for this client that I was talking about, it was COVID that monkeyed up the construction of the property, and that's what pushed it out so long. So that's good information.
Anybody that was in under COVID got an automatic 24 months. At that point in time, you're talking about 56 months, 55 months is effectively how long they had to get their projects done.
All right. So let's talk about the opportunity zones themselves. And is it going to be the LMI maps that you're looking at when you're looking at opportunity zones, or their own individual maps that have been drawn up by, you said, the governors in each state? So you then could go in and identify the area that you would want to invest in?
Yeah, so we've got a map of the OZ 1.0 census tracts that is on our website at ozpros.com/map. And so people can pull that map up and they can do searches and that kind of thing. We're working on a modification to it that shows the 2.0 tracts, or the eligible ones, and the rural census tracts as well. So the original legislation created, we call it Opportunity Zone 1.0, but because of the way that the reconciliation process has to happen when you're doing tax legislation, they had to put an end date on it. And so they put an end date of December 31st, 2026. And so that was going to time out. But Congress, in the one big beautiful bill, OB3, they made the program now permanent. And so there's now a new designation of zones that's going to happen at the second half of 2026. And so there's going to be another round of census tracts that get designated. They tightened up what you have to be relative to being low income. And so there's going to be a reduction in the amount of census tracts, but there's going to be new ones that get designated. And so new money under 2.0 now gets a rolling 5-year deferral, 10% reduction in taxes, 30% if you're in rural, and some other kind of perks if you're a rural qualified opportunity fund. But you also get a new designation of tracts. And as soon as we get that information from the governors, we'll auto-populate a map that people can be able to search and be able to figure out which opportunities in census tracts.
So would it be a fair statement to say that you're an active real estate investor, you have capital that you have to deploy, it would make sense to start with opportunity zones? When you're looking to identify properties to acquire or businesses to acquire, why not start in the opportunity zone just because of the added benefit?
So I had a mobile home park. I was in the mobile home park business for 20 plus years. And I had my last mobile home park that was here in Charlotte. And I was looking at what I needed to do to it relative to just maximizing cash flow off of it. And I was like, I could either do that on this project, or I could sell this one, use that capital gain to seed a fund, and now go build other opportunity zone projects and opportunity zones and make at least 24% more on my efforts because I'm not going to pay the capital gains tax. to the federal government. And if you're in a high income tax state, 24% is your baseline. Californians are almost at 50%. It's the blended rate there is ridiculously high. And so if I can do a deal and I can take the taxes off the table, why would I not do that deal?
Yeah, and opportunity zones are everywhere. It's not like they're in one state, one location. They're all over the country.
There's 8,700 of them, 8,700 plus of them right now, 8,763 actually. And they're in all 50 states and the territories. So 98% of the island of Puerto Rico is an opportunity zone. There's one in St. Croix. St. Thomas has got one. Guam. And so they are in every state. The whole notion of this is that you're investing into bad areas. It was according to the 2010 census tract that the tracts got designated. So a lot of those census tracts have rebounded significantly since then. And I think that there's a lot of alpha in the areas that haven't. And that's what real estate investors are looking for, is they're chasing alpha, the ability to be able to invest at one amount, be able to value add, and then be able to sell at a higher amount. And so that's literally the definition of opportunity zones. So you could save money in taxes and you could do some good by coming into the areas that need more investment than other areas that have gotten it.
So is there any specific projects or properties that maybe are better opportunities than others?
And what's funny is that I have people ask me that question all the time. And I would say that it's more a function of what can't you do in an opportunity zone than what can you do. And we've done farms, we've done daycares, we've done bakeries. I've done financial advisory firms that are moving into an opportunity zone now and are growing their financial advisory practice tax-free, dental offices. So that's the actual practice and the real estate that they're in. I'd say the one thing that's really not doable, it's really tough to do anything that's going to have loans as your primary objective. So if you were like investing into the stock market, so like a hedge fund or any kind of financial services business where you actually own the financial product, that's probably not conducive because of inside they created this rule that you can't have more than 5% non-qualified financial property, which is cash, stocks, bonds, accounts receivable, or partnership interest in another entity. And so that's literally the limitation that gets us the most. And then you can't also do sin businesses. So you can't do a golf course, a racetrack, a gambling facility, or like a C-store where you have off-premises alcohol consumption. Pretty much everything else is on the table.
Yeah, and I imagine they set that up. They're looking for you to invest in these areas, and they're looking for you to provide goods and services to the individuals in the area. So that does make sense. A laundromat or so many other things would just work perfectly for an opportunity zone.
That's right. A laundromat would be beautiful. Grocery store, right? We've got vertical farms that are going into food deserts. The list is endless with the exception of the sin businesses and the other things that are very financial instrument oriented that you have to hold on your balance sheet.
One of the things that got me when I was looking at the opportunity zones, and I think it sticks with a lot of people, and you just addressed it, but I'd like to go over it again, is the 2027 phase out or deadline. Can you re-explain the deadline and that we've heard about for years?
So in order to make the reconciliation number work, they had to cap and they had to end the program so that they could bring the numbers down relative to what the potential tax loss was going to be to the United States government. And so they said, all right, we're going to end it like on the same day that we end all of basically the Tax Cut and Jobs Act as a whole, which was December 31st of 2026. And so as a result, there was this perception that the program was basically done. That has been changed via the one big beautiful bill that got passed on July 4th of 2025. And so inside of that, they made the zones, they made this program permanent. They gave the governors the ability to designate new zones every 10 years. So now there's going to be a rolling designation of new zones. And now there's an ability to be able to bring new capital after December 31st, 2026 into an opportunity zone fund. Now, kind of the cool thing that happens for this 1.0 gap, right? The 1.0 to 2.0 transition is that 2.0 money can come in January 1st of 2027 and go into 1.0 tracks because those tracks don't expire until December 31st of 2028. So there's a 2-year overlap on the tracks. The other kind of cool thing, and this is why I don't think that, and we certainly have been busier than ever, is that as you come into December 31st, 2026, any money that goes in between basically the inception of the program and then gets deferred until December 31st, 2026. For somebody that's coming in 2026, that's not that big of a deal, with the exception of when you go to pay the taxes, you either pay taxes on your original amount of your gain or the value of your QOF investment at the time. And they had to do that in order to incentivize people to go into perceived riskier areas. And so if you can show a loss on paper, then you've got a unique kind of a once in a lifetime chance to be able to make an investment into a fund, write it down on paper, and pay significantly less than what your original tax bill was going to be. And let's be real, if you're going into a project that's under construction, you could be looking at upwards of a 50% discount, right? Because there's construction related risk. There's all types of other risks that you can put into a valuation discount. And so that's one of the things that we have a lot of people looking at right now, is that they're evaluating, hey, does it make sense for me to go ahead and recognize a gain, put it into a fund now, because I can then take that valuation discount.
I'd like to thank today's sponsor, Cost Seg RX, a cost segregation company. If you're interested in getting a cost segregation study, or if you'd like a free estimate of benefit, log on to realestateexplainer.com and click the cost segregation link at the top of the page. So if you're an individual investor and you know you're going to have a gain, so you take a gain on a property, you don't exactly know what you want to invest in or where you want to invest. Is there a marketplace or an area that you can go to see what opportunity zone funds are available for you to invest in? Because it's already an existing project. They're going to build a 100-unit apartment complex and they're still raising funds. So instead of you having to go find and create your own deal, it's plug and play.
Yeah. So there's a couple of different databases and other kind of sites out there that are trying to do that. There's not one that's really gotten a whole lot of, it's like the go-to site. I know that Oz Listings is trying to become that, ozlistings.com. And I think there's also the OZ Deal Exchange. And then Jimmy Atkinson, who's the host of the Opportunity Zones podcast, he's got opportunitydb.com, which is the opportunity database. And he's got a listing of funds. I'd say that the OZ Listings and the OZ Deal Exchange probably do a better job of highlighting like specific ones that people can invest in. I know that Jimmy also hosts like a pitch day where funds will go out in there and they'll pitch and they'll highlight their deals and that kind of thing. And I know that there's a number of those.
Because they're raising capital for individual projects.
Correct. So we have a mastermind that we do at OZ Pros. It's basically more of a how-to. So like, how do you actually do opportunity zones? It's a weekly call that we have. And we have a community that it's a community platform that people can access. That's how they get into the calls. That's how they can do the replays. And inside of that, we actually have a deal exchange for our members. That's member exclusive, but I've got a special deal for your listeners at ozpros.com/podcast, where I've got a free month of that. If anybody wants to join and take a look at the deal exchange, they can click through and they can jump into, it's called Ascent. That's our mastermind. They can jump into Ascent and they can find the deals that we've got from our members inside of there. And like, those are known deals that have been vetted by the kind of general consensus of the people that are in my mastermind. And so we like those deals.
That's exactly what I was thinking, because you'll have someone or the average investor who has gains and they're looking to buy a business and they're looking to offset potential taxes. They may not want to go and build a bunch of duplexes in an opportunity zone. So without having that deal vetted and really understanding what you're getting into, unless of course that's your background, you're a real estate professional, you're very familiar with building projects or flipping projects or doing value add, that would be for one type of investor. But if you're another investor, you just sold your business and you've got $1 million that you're looking at redeploying, I wouldn't be comfortable saying, hey, just go build an apartment complex or build a restaurant or a strip mall in an opportunity zone. So I think having that group that you could connect with would really make sense.
Yeah, the great thing about the program is that theoretically, I know a lot of people that have sold, I was in the M&A space for 10 years prior to doing this, is that they would actually go and start another business. We help them do exactly that with their capital gains. And they put that money into starting their next venture. But to the extent that they're ready to not do that, they're like, hey, listen, I want to put my money with some known fund managers that can really maximize the return on it. We certainly have those folks that are doing individual deals like that. What's actually cropping up recently, I'm part of a fund that's doing this as well, is that there's a play inside of the opportunity zone space to be able to come in and recapitalize deals with new equity. And so a lot of this stuff got built during the run up, and there was a lot of capital that got deployed into multifamily deals and into other deals where they came into an interest rate environment that was not very favorable as they started to deliver these deals. And so the deals are working, they are stabilized, but they are really struggling because of the onerous debt terms that they have on them. And so we're actually coming in and recapitalizing some of that debt with preferred equity and being able to get an immediate cash flow return to our investors as a result of that. And then also a fairly clear runway to what we're going to be able to exit it with. So it's cool to see that type of secondary capital markets sophistication that's now hitting the opportunity zone space. And I think we're going to see more of that type of financial engineering now that the program's been made permanent. We've already seen $150 billion go into opportunity zones. I think we're going to see even more than that happen now.
Yeah, I agree with you. I think it's a real win for businesses, for opportunity zones, low to moderate income areas that are really looking to be redeveloped and an influx of capital to come into them. And like you said, these are not always in bad areas. I live down here in Florida, and I've seen areas in our local market that were in opportunity zones. And I think it really has to do with the income of the population because they're more fixed income. And that's the reason. So these guys have stable income. They're spending their income. It just has to do with the region or the area.
They hit on the poverty threshold as compared to the national average.
So real opportunities. One of the other things that I was reading on your website, and I want you to talk about a bit, is using your services to actually set up an opportunity fund. So we're talking about opportunity zones themselves, but it's actually going in and setting up both the opportunity fund itself and then setting up the LLC or the corporation that the money moves into. What's that process look like?
Yeah, we try to make it as easy as possible, where it's a flat fee and we set up your qualified opportunity fund, which is an LLC taxes and partnership. Typically, we set up your qualified opportunity zone business. We then walk you through how to get your bank accounts set up. We get you all of the ancillary documents attached to that, walk through how to set up the bank accounts. And then we walk through specifically how to fund those bank accounts to flow the money into your fund first and then down into your QOFs, and then how to purchase whatever your transaction is going to be, whether that's an operating business or whether that's a real estate deal. And so we try to make it as painless as possible so that people can get out there and do these deals, but do them with confidence because, once again, like I said, this is an as of right deal where you don't have to ask for permission from anybody, but you better make sure that your documentation is tight. And that's what we help people do. So we've got it to where we'll just set people's stuff up. We've also got our Ascent where people, if they just want to come in and ask questions, they can do that. And then we've got the full Monty where we set them up. They get access to Ascent. They're in there learning from us on a weekly basis. And then we actually do their compliance for them as well, where we assemble their audit trail and make sure that it's done correctly. That's what we have set up as OZ Pros. And with the goal being that we wanted to enable Main Street America to be able to do opportunity zones, not just talk about them, not just hear about them, but actually get out there, get into the weeds and get them done.
Now, when it comes to the opportunity fund itself, what dollar amount should you expect to put into an opportunity fund to make it really pencil out?
Yeah. So once again, it's not about your initial gain. It's all about the gain that you expect into the future, because that's where the real juice lies, is in that 10-year step up in basis to fair market value. So I have people that are setting up businesses and they may set up the business with $5,000, right? So they have $5,000 worth of capital gains, but they're anticipating that they're going to be able to grow that business into hundreds of thousands of dollars of revenue that'll be able to trade in the 7-figure range, sometimes multiple 7 figures. And so it's all about what that future gain's going to be that you think you're going to have. That's where you use to adjust whether or not you're going to do an opportunity zone deal. And so that's the threshold that I typically tell people. And you can do some back of the napkin math relative to like our fees and like what tax rates are at this point in time, and then doubling your basis. I'd say that if you're buying at least a $500,000 deal as a real estate investor, you're expecting that's probably going to double over 10 years. Ideally, it triples, right? If you're really paying attention to your rate of return, you're going to expect it to triple in 10 years. But even if it doubles, that's $250,000 worth of gain that you're going to pay 24% in taxes on. And so you can back into the math relative to like how much it's going to cost you to set it up with us and then to do the maintenance on an annual basis. And if you're doing a $500,000 deal or up and you think that it's just going to double, that pencils out to where it makes sense to spend the money to do it. If you're doing any deals bigger than that, absolutely. And if you're doing an operating business that you think is going to be a moonshot, you'd be crazy not to set it up as an OZ deal.
Yeah, that answers the question perfectly. And then the fund, how do you unwind it? At what point does it unwind?
Yeah, so that's the great thing about this too, right? With a lot of deals, it's, oh man, like what happens if I decide that I got to get out? You just sell your stuff and you just pay the taxes during that tax year. There's no penalties. There's no back taxes. There's nothing like that. You just sell it and you pay the gains. That's if you're before 10 years. If you're after 10 years, then you sell your stuff. Let's say that you sell all the assets that the fund owns. You could conceivably continue to add to your fund along the way. And so then when you sell something, you're just taking the step up in basis to fair market value and then distributing the money out to yourself. And now you have after-tax cash that hasn't been taxed. If you ultimately sell everything inside of your opportunity fund, then you just shut it down just like you would in a normal company.
So after 10 years of acquiring this business or this property, in 10 years, you get the step up in basis. What does that mean to my tax liability?
You can elect to take a step up in basis to fair market value when you transact. Now, it could be a transaction to anyone. And so you could transact with yourself and get the step up in basis to fair market value. Realistically, you're probably not going to do that. And you're going to say, hey, how long can I hold it instead of how long do I have to hold it? And the answer is under 1.0, it's 2047. Under 2.0, it's 30 years. And so that becomes really powerful. The seventh wonder of the world is compound interest. Eighth wonder of the world is tax-free compound interest. It becomes a really powerful vehicle for building generational wealth and for being able to just increase the value of something. And so the way that the step up in basis to fair market value works is that you are going to pay taxes between what your basis is and what your transactional amount is. And typically you're going to be transacting at fair market value. And so the difference between those two is what you pay in tax. You pay capital gains taxes on that. If inside of your basis, you have a certain amount of bonus depreciation that you've taken, then you're going to get stuck with depreciation recapture on that portion of it inside of an opportunity zone deal because it steps up your basis to fair market value and not only eliminates the capital gains, but it also eliminates that depreciation recapture. And so what people are now saying, okay, I have to hold it 10 years, but I get to hold it 30. I'm really starting to shift my mindset into investing into things that instead of looking at it like, okay, what's the highest IRR I can pull on something? And what's the shortest amount of time that I need to hold it in order to get that IRR? Then instead they're saying, okay, I have the ability to let this thing eat tax-free for 30 years. Why would I not continue to do that and get the maximum amount of value appreciation in it that I can then take out tax-free and then go do something else with that money? And so a lot of family offices are really looking at this. My phone's been blowing up with people that are engaging me to help them put together their strategies along those lines about how they can now shift to this more 30-year hold period because they are recognizing that transactional drag is really impeding their overall IRR over a significant period of time. So they might have a 15% IRR that they get over 3 years, but they have to pay taxes. They have to pay brokers. They have to pay lawyers. They have to pay all of the transactional costs associated with flipping those deals every 3 years. And then if they're in a 1031 situation, now they've got the gun to their head relative to a timing on when they actually have to redeploy. Inside of OZs, that's not the case. It just eats while you're holding it.
And the step up in basis, going back to that and talking about generational wealth, because that's a real thing that we talk about when we're talking to our clients, is legacy wealth. What are they going to do? And one of the main benefits to the heirs of these individuals that own property is they do get the step up in basis. So the cool thing that I'm just getting with the opportunity zone is now you don't have to wait. You don't have to pass it on to your heirs to get that benefit. As the individual investor, you get the step up in basis after 10 years.
So when you transact, the really cool thing about it, because you're onto something here, is that if you die before you transact, it's not fair market value that goes against your estate. Because that's one of the tricky things for folks that have big portfolios, is that the lifetime exemption amount's $15 million per individual. So if you're above $30 million on your net assets, then you've got to be concerned about getting that step up in basis when you die, because now you owe 40% on whatever that is above $30 million. Inside of an opportunity zone deal, if you die while you're holding it, your estate steps into your shoes. And so they don't pay taxes when that happens. And the only amount that goes against the estate is not the fair market value, but instead what you originally put into it. So just as an example, you got $1 million of gain that you put into a fund this year. You're going to pay the taxes in 2027. You get hit by the proverbial bus in 2028, right? And let's say that it's 2037, right? This thing has climbed in value and it's now worth like 5x, right? So it's worth $5 million instead of one. Normally, that would go at $5 million against your estate, against your lifetime exemption amount. If it's an OZ deal, only $1 million goes against your lifetime exemption amount. And then your estate steps into your shoes, and then they would go to sell, and now they can take the step up in basis to fair market value. So they get the benefit of that $4 million without paying taxes to anybody on it, estate taxes or any kind of capital gains taxes.
That's it. It sounds like a win-win. Let's go ahead and wrap up the podcast. If listeners want to get in touch with you and learn more about opportunity zones, what's the best way for them to reach you?
ozpros.com/podcast. And I've got special offers in there for your guests. So I've got a free month of access to Ascent, which is our mastermind. I also have a masterclass that they can do as a video. It's free and they can learn, and it literally goes through in detail what we've been talking about. Final place is if they want to learn more and they really want to dive into the weeds on any of these particular topics, I've got a slew of videos on YouTube at youtube.com/ozpros. And reach out. We'd love to help your listeners to figure out how they can work opportunity zones into their real estate and or business strategy.
Perfect. Thank you for joining me today.
My pleasure, Brian. Honor and a privilege to be here.
If you've enjoyed today's episode, please leave us a 5-star review and click the subscribe button. It only takes 5 seconds and it really helps us grow the show.